What is up, everybody? Welcome back to another exciting episode of Fed Watch. Today is FOMC day, so we should have a very good show. My name is Ansel Lindner. I'm here with my co-host CK, but we also have a guest today, editor at Real Vision, Andreas Steno. How are you doing today?
Good. Thanks for having me.
Awesome, man. I ran across your stuff a couple months ago on Twitter, and then you really piqued my interest a few weeks ago when you were trying to talk sanity into the European energy crisis. So had to have you on to talk about that. But being that today is Fed Day, I guess we should start with that. What's your takeaway of the 75 basis point hike? Is it what you expected?
Well, more or less, yes. I mean, the Fed is sort of crystal clear today. They don't want us to bet on a pivot this year, at least. If you look at the updated dot plot, so the median projections from the members of the Federal Open Market Rates Committee, they essentially tell us that they intend to hike interest rates all the way through this year. I think the median projection is now between 4.5% and 5%. Most of the members leaning towards an interest rate above 4.5% by year end. So, I mean, they quite frankly tried to tell us that we shouldn't bet on a pivot. They've quite frankly tried to tell us that we shouldn't bet on higher levels for risk assets. So they're trying to bring asset prices down. Whether they will succeed is another question. But at least the intent is pretty clear from them today.
Yeah, awesome. Yeah, I forgot to give you time to introduce yourself, man. I just got right into the content. So, Andreas, can you tell us what you do with Real Vision and tell us about your newsletter?
Yeah, I mean, I'm born and raised in institutional banking. So I've been heading strategy teams in various Northern European investment banks for more than a decade. But now I'm contracting with both Blockworks and Real Vision. I'm hosting the daily briefing at Real Vision a couple of times a week, and then also hosting essential interviews behind the paywall at the Real Vision platform. And then I have my own Substack called Steno Signals, where I try to sort of cut through the macro noise, in particular on the energy front right now, because it's very needed. I've seen so much misinformation on this European energy crisis. Just to say it up front, it is a crisis, but I've seen so much misinformation anyway. And therefore, I've decided to spend most of my time on that recently.
Awesome. Okay, now getting back to the Fed stuff. You were talking about the dot plot and about 4.5%, and they want to get to the end of this hiking cycle, but they're saying there's going to be an end, right? So I always think that, okay, maybe they're not pivoting now, but they're telling us they will stop eventually, and they're telling us they will pivot eventually. And so, that isn't that what the market is sniffing out? What do you take, or what's your take on that?
Well, I think you're right, given that equities have started to rebound during the press conference with Jay Powell. The important point here is obviously whether the Federal Reserve will keep monetary policy tighter than average for long, right? And if we look at the dot plot, they send a very clear signal for the short run. But for the sort of medium-term projection, it's more like a wobbly signal, I'd say. They intend on bringing the interest rate lower again because they clearly find themselves to be in what they call restrictive territory right now. So a rates level that will sort of decrease the activity in the overall economy. And they don't intend to stay at such levels for too long because they know that's very harmful. So the question is whether they will succeed in bringing asset prices down with this message, because I essentially think that they want to bring asset prices down even further because it's the simplest way to kill inflation.
Okay,
Andreas,
go ahead.
All right, no, go for it.
I was just going to say, so you're saying that asset prices, they're targeting asset prices as a way to target CPI. What do you think about the CPI being at close to 0% for the last 2 months here in the U.S., at least headline? That's not core, of course, but what's your read on CPI and peak CPI?
Well, I've probably tried to call the peak in CPI a couple too many times this year, but if I look forward on US CPI, I feel very convinced that in 6 months from now, all of the so-called inflationistas, they will be much less loud than they are right now. The reason being that some of the price surveys that we conduct among SMEs in the US, they point clearly downwards now. So the pricing power of corporates is worsening right now as a consequence of a weaker economy, as a consequence of larger inventories and stuff like that. The main culprit in the consumer basket right now is housing, mainly due to the methodology. So the way that we measure housing costs in the consumer basket is, if you ask me, extremely outdated. It kind of measures the development seen in house prices through 2020 and 2021 with time lag, as we only ask 1/6 of the overall target group of the shelter cost category in the consumer basket every month. So it simply takes time before that survey actually catches up to the reality. And therefore, I'm pretty convinced that this is sort of the only category that the Fed will now need to bring down. And if we watch the developments in house prices right now, I'm fairly certain that in 12 months from now, this shelter cost category, which is the main culprit right now in inflation, will be at much lower levels than what we see today. So yes, I dare to call the peak, and I actually think we have peaked already, to be honest.
Andreas, I'm kind of curious. For me, I find that there's this strange contradiction between CPI increasing, maybe because of inflation, but definitely because of supply chain destruction, conflict, that kind of thing. And I find that there's like this contradiction with trying to solve that by increasing rates. Obviously destroying demand and making it so consumers can't consume is definitely a way to reduce demand on scarce goods. But I guess, can you talk about that kind of like contradiction between central bank activity and what's actually happening in the economy?
Yeah, I mean, if you ask sort of a textbook economist whether it's a good idea to hike interest rates due to a supply shock, the answer is no. And I frankly also find it to be a wrong path to pursue, given the amount of supply issues that we're faced with right now. They're getting better, but they're still around, right? The issue is that it's sort of the only weapon available to the Federal Reserve, right? They cannot do much to support the supply side in any way, right? So they can only sort of try and contain the demand side, which is why they simply have to do that, given the incentive structure that we've given them. If you look at the incentive structure of a central banker, if inflation runs 5, 6, 7 percentage points above the target that you've been given by the politicians, then you don't really have a choice, right? You need to do whatever it takes to bring inflation back towards that mandate, even though you're sort of fighting a battle that you cannot really influence too much, given the weapons that you have available, right? So I get why they do so, given the incentive structure that we've given them, but I don't find it to be the right medicine, or the right cure, rather.
Yeah, that's a great point. And on the supply side of stuff, there is obviously a big difference between the challenges that Europe is facing and the challenges that the US is facing. Europe seems to be behind the US in how fast they're hiking and stuff. So can you, for a lot of us in the US, and we don't really follow the ECB as closely as we should, what is the ECB doing right now? And do you think that there's going to be any sort of divergence in the future where the Fed pauses, but the ECB is still hiking?
The ECB has started hiking recently as well. So they hiked by 75 basis points at the last central bank meeting in Europe as well. But they're clearly running sort of behind the Federal Reserve in this battle. Maybe as the inflation that we see in Europe is even more supply side driven than what we see in the US. And I mean, the European Central Bank is sort of a funny institution, right? It is an institution made up by, I think it's 27 member countries thereabout, and they all hold a seat on the board, right? So in order to sort of form a consensus within the European Central Bank, you will need to have a majority of countries supporting the decision making, and usually there is a huge divergence between the opinions in the northern part of Europe and in the southern part of Europe, mainly due to sort of strong divergences in terms of the public debt load in Southern Europe versus Northern Europe, and that is the exact reason why it's taken so long for the European Central Bank to act, even though inflation is actually running, I'd say, even hotter in Europe than in the US by now. And they are, I'd say, they're trying to do something, but they cannot really do much, given that they also need always to have an eye on the euro construction as a whole when they conduct monetary policy. If they hike rates aggressively, it's usually something that spills over to negative developments in Southern European bond markets and Southern European equity markets. And I guess the euro construction can only swallow such a turbulence in Southern European debt markets to a certain extent. But by the end of the day, the European Central Bank has time after time been called to action to support the developments in Italy and Spain, for example, when they've tried to sort of tighten monetary policy. So it's a very different beast from the Federal Reserves due to all of these country by country considerations that we simply need to be on top of when we assess the European Central Bank.
Awesome. Yeah, great answer. So a lot in the past, there's been a lot of harmony between central banks and their monetary policy. They either were all easing at the same time, or it was kind of surprising if you saw a major central bank kind of out of step with the other central banks. And so there seems to be a lot of coordination there. Does the Fed feel that coordination? They seem to be hiking, and at all costs, they're just going to rise. The dollar's going to rise. They're just going to keep hiking and let the ECB and the BOJ, fend for themselves. So do you think the days of central bank coordination are over, or at least maybe they're, on pause right now, where everyone it's every central bank for themselves?
Yeah, it seems as if we've entered sort of a new regime when it comes to monetary policy, because when inflation is running above target, all of a sudden you actually want to have a strong currency, not a weak currency against your peers, because with a strong currency you import less inflation, right? And that's probably the reason why the Federal Reserve has sort of chosen to move ahead with rapid interest rate hikes despite a very strong dollar, because they know that the dollar at current levels is sort of a global wrecking ball. Just watch the developments in Sri Lanka and elsewhere in emerging markets. They simply cannot withstand the dollar at this level, paired with high food prices and electricity prices at the same time. I think we should expect more more devastating scenes from emerging markets as a consequence of this. But the Fed doesn't care this time around. They used to care about stuff like that, but certainly not this Fed. And therefore, I think you're absolutely spot on that the divergence that we see between the big central banks will only currently grow bigger. I mean, someone needs to call Bank of Japan and tell them what's going on elsewhere. I mean, they've essentially fallen asleep over there, right?
Yeah.
I mean, every other central bank is moving, and they are still just stuck in a debate on whether to keep interest rates at 0.1 or 0.15 at the 10-year point on their yield curve, right? Quite interesting, given that they actually have inflation above the target, etc., in Japan as well. But my take is, now that I've tried to make fun of them, is actually that they have it right to a certain extent at Japan, because I think in 6 or 9 months from now, we will be faced with a completely different reality in terms of inflation, right? I think the deceleration in inflation will be pretty rapid. And therefore, by the end of the day, it could be that they've chosen the right path in Japan. Let's see.
So speaking about central bankers not necessarily being in unison, I saw a hilarious meme. I actually had to tag Ansel in it this morning, but it was effectively like a slap competition, and one of the girls in the competition had the Fed, and the other one had the ECB, and it was like almost portraying these central banks are taking turns at delivering kind of blows to each other. Can you talk a little bit more about like the dynamic of these central banks not necessarily being in unison, and maybe what difficulties that kind of pushes on them from a policy perspective?
Yeah, I mean, the simple pass-through mechanism for a central bank policy is the FX rate versus other fiat currencies around the world. So very clearly, when the Federal Reserve started moving ahead of other central banks, the US dollar started gaining as a consequence of a wider interest rate spread between the US and, for example, Japan or Europe. I think one of the reasons why the European Central Bank simply needs to act with high interest rates now is that they will have to defend the euro exchange rate to a certain extent, because otherwise they will simply continue to import inflation via the FX channel. And I mean, we've all seen the development in the euro versus the dollar over the past 18 months or so, from was it just south of 120 to 0.98 or thereabout today. It's been a landslide. And think about a situation without interest rate hikes from the European Central Bank. They've actually increased the policy rate at the last two meetings. We would have been at, I don't know, 0.95 or 0.9 in the euro versus the US dollar, thereby importing even more inflation on top of an already accelerating inflation picture in Europe. So it sort of changes the dynamic when inflation is running hot around the globe, because all of a sudden this is sort of a fierce battle in FX space, trying to get the upper hand against other central banks when it comes to the relative level of interest rates to support your own currency. Because everyone wants a strong fiat currency these days, in sharp contrast to what we saw throughout the 2010s, right? Everyone tried to sort of manufacture the weakest currency development. Even the US Federal Reserve started involving themselves in such considerations. The European central banks certainly did so as well. So this is kind of the world upside down in fiat currency space relative to what we saw just before the pandemic.
Yeah, well, one of the things that people have been predicting for a long time is the end of the euro. And being a Bitcoin channel, we always want to, think about currencies, the evolution of currency, whether it can ever get to Bitcoin and stuff. Do you see the euro facing some sort of existential crisis from this? Or because, I mean, we could get into the politics of it. We had some recent elections in Sweden. We have an election coming up, I think, at the end of this week or maybe early next week in Italy. There seems to be a lot of like Euroscepticism, or EU skepticism, I should say, not necessarily Euroscepticism. But do you see the euro facing some existential threat from all this?
Well, let me put it like this initially. The euro is one of the crappiest constructions I've ever seen. I mean, it is basically designed to fail all the time. So the reason is that you've invited several member countries to the same club without them having some sort of formal policy design that they sort of coordinate across borders, right? So one country enters with a very strong fiscal profile, a balanced budget, no debt, while another country enters the euro construction with a truckload of public debt and massive fiscal deficits, no structural reform, stuff like that, right? So it's really a mixed bag of goodies if you open beneath the surface in the euro construction. So no, I simply cannot see how the euro construction survives for longer than the three of us. I would be very surprised, at least, if it were to survive that long, simply due to the fact that you cannot have a currency union between people with very different opinions on how to run a budget. And I have to admit that the cultural differences between some of the member countries is just humongous, and that's the reason why they cannot agree on sort of a fixed set of rules before entering this construction, right?
Mhm.
So I think it's a very bad construction. I think you can hear that by now. It's of course always tricky to figure out exactly when such a construction will eventually have to break down. What we saw through the pandemic was actually a move in the other direction, if you ask me. European unity as a consequence of the lockdowns, and the European Union even started issuing some sort of common debt between the member countries, trying to distribute the bill around the continent, etc. But I think this energy crisis is a whole different beast in that regards, because what we see right now is sort of the first signs of what I call energy nationalism in Europe. So each and every country trying to fill up their own storages before exporting energy to other countries. Makes a ton of sense, by the way. And we have seen a couple of countries already pointing out that, well, if we don't have the energy, then we are, of course, not exporting energy to our neighbors before we ensure that our own population has the energy that they need. So this is a different beast compared to the pandemic when it comes to this Euro construction, because I think there are scenarios this winter that could lead to quite a negative development in Europe when it comes to this energy crisis.
All right. Well, you broached the topic here, the energy crisis. So yeah, I like that idea, the energy nationalism. Can you give us just an update on what it's looking like with their national reserves over there by country? You know, it's starting to get into past summer. I mean, it's starting to get a little bit cooler outside, so I think this might be front on people's minds. I mean, it already is, but you know, might be getting to crunch time a little bit to make some decisions here. So what is the current status?
Well, if we look at the situation in natural gas space first, the storage capacity in Europe is certainly not big enough to cover all of the consumption needs over the course of the heating season from October until March. But the storages are almost full by now, and the European Union basically agreed on a strategy where they aimed at filling up all of the storage capacity in Europe by the 15th of November. And I guess we are very close to filling up the storages already today. So basically way ahead of the curve in terms of storages. The flip side is that right about every European country started bidding up the price of natural gas at the same time, right after this legislation was agreed upon in the European Commission. And that was the exact reason why we saw the explosion to the upside in the so-called TTF natural gas price traded in the Netherlands earlier in August. But now that storages are full, I mean, who's left to sort of bid up the price right now? Because obviously, we're still at a point in the seasonality where we use less natural gas than what we import per day. That will turn around by roughly mid-October, where we will start to see withdrawals from the storages to ensure that the natural gas demand is covered on a daily basis. But to take an example, I mean, we've been talking a lot about Germany, in particular in US media. Will Germany freeze this winter or not? I think the base case is that Germany will actually make it through the winter without even having to ration gas. And I'll tell you why. If we look at the overall storage size of the German natural gas storage sizes, they can storage around 245 terawatt hours of natural gas, and they're very close to filling up those storages completely already today. If we look at a usual month during the heating season, right about 110, maybe 115 terawatt hours of natural gas is used per month. So that essentially means that without any inflows at all into Germany, this storage can sort of cover 2.5 month of heating demand. But we should also remember that the inflow is actually still pretty decent, even though Russia has sort of stopped the flows via the all-important Nord Stream 1 pipeline and also the Yamal-Europe pipeline, so the two biggest pipelines running into Europe. But, I mean, Germany clearly have other suppliers, Norway, Qatar, the US, for example, and the flow is still running at levels just south of 90 terawatt hours of natural gas per month. So all in all, when we do this calculation, we have a starting point of 245. We have a monthly reduction of 115 due to demand, and we have a monthly inflow of a bit less than 90 from other sources than Russia. Then I end up net with the storage being filled up to an extent of a little less than 100 terawatt hours by 1st of April next year. So it's not that bad. I mean, to me, it's been exaggerated in the US media, but obviously there is a worst case scenario with, a very, very cold winter like we used to know them from, say, the 1920s or thereabout. But if you take sort of the average temperature over the past 10, 15 years, then there are no issues for this winter. I can promise you that.
Awesome. Very detailed answer. But isn't there a threat that the economic damage has already, some of the economic damage has already occurred, of course, with different chemical plants having to shut down in Germany and Poland and those places. It sounds like there could be a dramatic swing in prices down very low before winter, if you're saying that the storage is already full. Is that the case?
Yeah. I mean, the reason why the spot price basically exploded to the upside in August was this piece of legislation from the European Commission. So they asked all member countries to buy natural gas spot at the same time. Not necessarily a smart thing to do, but nonetheless, they've managed to fill up the storages ahead of schedule as a consequence of this. So I think you point to the exact issue. One thing is whether the Germans and the Europeans will make it through the winter without even having to ration natural gas. But the flip side of that is the price that they've paid for the natural gas. And that price is certainly out of league with anything seen ever in history. So I made the calculations, I think a couple of days ago, and you can see it in my Twitter feed, on the energy cost as a percent of GDP in various European countries. And we've gone from paying around 2 to 2.5% of the gross domestic product on an annual basis for all of the energy needed in the economy to paying above 10% of GDP for energy this year. So basically a move of 4 times the level seen in 2020 and 2019 thereabout. So it is a massive game changer, and the European economy is basically an economy designed to lever up on cheap energy from Russia, and that cheap energy is long gone.
So a really interesting situation, right, where European energy authorities are effectively kind of like filling up the reserves at peak prices, almost buying the top on what you are forecasting to, be a probably sharp decline in energy prices. I'm kind of curious, like, how does European energy policy, start moving in a more positive direction following what is probably going to be a pretty rough punch in the face when this is all said and done? People have been talking about going back to nuclear. Obviously, Russian gas is now something that can't be relied upon. Like, what kind of comes next in terms of energy policy?
Well, it depends on which country you ask in the European Union. We need to remember that this is what I call a self-inflicted crisis, because if you look at the decisions taken in Germany and in France over the past 10 years, they've basically allowed Putin sort of a window of opportunity, slowly but surely, by closing down nuclear capacity, deciding to use more or less solely Russian natural gas, as sort of the ground layer or the stable source of electricity in the European electricity grid. We should remember that many countries in Europe, they are self-sufficient on electricity via renewables, but as we know, renewables, they are extremely volatile in terms of when, where, and how they actually produce electricity. So what Europe basically needs now is a new stable source of electricity. And I mean, if you ask me, the simple answer to that question is nuclear, but it obviously takes, I'd say, at least 6 to 8 years to really get on top of that regime shift in terms of electricity production in Europe, if we go down the road of nuclear, since well, some countries don't even have sort of the know-how, so we will have to import know-how, we will have to start rebuilding, et cetera, et cetera. It will take years. So I guess the short-term solution, and you've already seen it via the spillovers to the US natural gas price, is to import liquid natural gas via the seaway, basically from the US and Qatar, with an arm and a leg. And we will pay whatever it takes over the next couple of winters to get that liquid natural gas from the US. And right about every country in Europe is currently building capacity to receive liquid natural gas. Germany, the Netherlands, Italy, Spain, they're all trying to increase the capacity. Quite needed, given that it's probably not feasible to expect any Russian gas to come online again.
One thing that I've been thinking about is, there is a lot of energy in the Eastern Mediterranean. And if Europe, they can't rely on Russian gas, and it almost seems more realistic to pivot south and, be more engaged in Mediterranean politics. So that's one of my calls for long-term future is Europe kind of pivots south, back into the Mediterranean politics, Middle East stuff. What are your thoughts on finding, you don't have to go all the way to Qatar. You can actually just go to Israel or Egypt.
Yeah, well, you're absolutely right. Both Spain and Italy receive natural gas flows from the northern part of Africa, mainly Algeria. But you're right that there are resources in other parts of the Mediterranean area, also around the Black Sea, towards the Romanian border. So this is obviously one of the things that we need to exploit over the course of the next 3 to 5 years. But I mean, from the stage where you try to exploit these potential fields, etc., until the actual delivery date, I'd assume that it will take quite some time, even if we know that the resources are there to a certain extent, and therefore the short-term answer is liquid natural gas, to a much larger extent than trying to exploit the underground in the Mediterranean and some of the outskirts of Europe. There is also a huge natural gas field in the Netherlands, just outside of the city Groningen, and I mean, it's running at 1/10 of its max capacity due to some light earthquakes in the area surrounding Groningen, and I mean, in between 20,000 and 25,000 inhabitants of Groningen have sort of filed a case against the Dutch state, and it's still an unresolved matter. But I mean, given that Putin sort of holds a whole continent hostage to this natural gas situation, I simply don't get why we don't exploit that gas field in the Netherlands now that it's already up and running, just because of the risk of an earthquake surrounding that city. But I mean, I'm not a politician. There is probably a reason why.
Yeah.
Andreas, I want to slightly pivot the conversation back to, let's just say, instability with how the euro is constructed and how that might shake out with the stress. Ansel and I on this show, we do talk a lot about being bearish on how the European Union is currently constructed and how the euro as a money is really kind of a weak link in the global financial system. And we actually see the potential downfall of the euro as being a positive for Bitcoin as an alternative to the dollar. I'm kind of curious, what is your take on Bitcoin specifically, maybe cryptocurrency, Tether, euro, dollar stable coins as part of that, and how that could play in with a negative situation for the euro?
I mean, it's quite obvious when we look at the use case for Bitcoin around the globe that the bigger the turbulence surrounding the fiat currency, the bigger the use case of Bitcoin. We see a relatively strong use case for Bitcoin in many emerging markets, and I mean, should the euro start to resemble the Turkish lira, the Sri Lankan Rangjit, I think it's called, but the fiat currency of Sri Lanka, currencies that have been faced with extreme volatility as a consequence of bad decision making by policymakers, as a consequence of a weak fiscal system, then I think the use case for Bitcoin will also grow in relative terms to the euro, right? So I think you're absolutely spot on that if this energy crisis turns into an even bigger euro crisis than what we've already seen. I mean, it's bad enough when you look at the development in the euro versus the US dollar. Then I think it gets even more tempting to asset allocate to alternative sources of money relative to the euro, as a consequence of a lack of trust in the construction, as a consequence of a lack of trust in the fiscal system. And I mean, I don't think we're there yet, but it's like we move there sort of in cycles. We're currently heading towards a new low, a lower low than what we saw in the last cycle, and we don't make new peaks in terms of sort of the fiscal stability and the fiscal trustworthiness around the euro. So it's kind of on a dissipating trend towards zero trustworthiness over time. So from sort of a structural perspective, I think it leads to an increasing relative use case for crypto, either Bitcoin in general, relative to the euro when we are faced with issues like the current.
Awesome. CK, did you have a follow-up for that? I was going to pivot back. Go ahead.
Yeah, no, I guess like if we have to follow up on this, the topic is Bitcoin versus US dollar stable coins. I feel like they're both both currencies potentially could be like a relief valve. Obviously the dollar is kind of the world reserve currency right now. As there's turbulence in other markets, people flood to the dollar, but that also makes life harder because contracts being denominated in dollars, that actually makes their liabilities worse. Like how does dollars, stablecoin, and then potentially Bitcoin as something completely separate, how they interact in this kind of future where fiats are failing?
Well, I mean, I don't think that we can claim that the US dollar is failing yet, even though the sort of long-term value of the US dollar relative to goods is obviously on a downwards trend, right? But it's kind of by design via the monetary policy of the Federal Reserve over the past 100 years that the US dollar needs to weaken versus things that are in sort of scarce supply, right? Such as physical goods. So ultimately, I actually think that it is how the system is designed. And we've deliberately designed the system that way to ensure that inflation is running in positive territory. The flip side to this argument is that if you allow a monetary system to run with a fixed set of supply, then the overall inflation picture will sort of turn around as well, right? If you have a fixed set of money relative to a potentially slightly growing set of physical goods, then you would actually encounter deflation on a running basis. And I mean, you wouldn't get a lot of friends at the economic institute at universities if you started telling them that it would be smart to run an economy on a deflationary trend. I'm a bit more uncertain myself, since it's been quite a while since we actually tested it in real life, right? So, I mean, let's see where we are headed. But I think there's still quite some time before we really try and meddle with the current dollar system. I think the system is basically designed to re-increase the supply of dollars at a running pace, and thereby also sort of re-increasing the amount of dollar credit and dollar debt, both domestically and internationally.
All right, I was just sidetracked. My boy came in here and opened the front door, so I missed the second half of your answer. But yeah, I wanted to pivot back before the end of the show here, because we just have a few minutes left, to the Fed, the FOMC today, and what your outlook is for the rest of the year. I know you said that their dot plots are saying this, but CPI is coming down. So if you had to, I guess, project forward, what do you see for from the Fed for the rest of the year?
Well, I expect them to continue to hike interest rates throughout this year, probably at a lower pace than what we've seen today with the 75 basis points. So I'll expect them to sort of slowly but surely move towards 50 basis points, then 25 basis points, and then towards zero, probably sometime in the early parts of next year. The reason being that it's pretty clear by now that the asset market is sort of reacting to the monetary policy, which is exactly what the Fed wanted it to. If we look at the inflation-adjusted interest rate in the US, it is now in positive territory across the entire yield curve, which is something that we haven't seen in quite a while. So the nominal interest rate is higher than the expected inflation for each and every tenor on the yield curve now. Usually, what we've seen once the real interest rate is back in positive territory is that something breaks relatively fast after that in the asset markets, in the overall economy, for example, in the housing market. So my take is that we have a pretty bad scenario coming during the next couple of months when it comes to returns on risk assets, and from right about everything from equities to crypto, to even bonds in this scenario. And ultimately, that is what's needed to convince the Fed to turn around, because when you break asset markets, when you break the housing market, you also make sure that inflation breaks the neck. Or you break the neck on inflation with a time lag. It is very effective as a way of bringing inflation down, and therefore, the sad message is that we need some more pain in markets before we should sort of reload our positionings. The only sort of glimpse of hope I can find right now in relation to that is that the market sentiment is extremely negative. Just look at the positioning in crypto, in CFTC data. Look at the positioning in E-minis, in CFTC data as well. It's almost record negative. When you look at Bank of America's investor survey among big hedge fund, big asset managers, they all tell you that they are running no risk at the moment, and then they run less equity, less crypto exposure than usually. So, I mean, we're probably not too far off the bottom, but I'm not buying with an arm and a leg yet.
All right. Well, Andreas, really appreciate you coming onto the show and giving us a lot of valuable insight into what is happening in Europe. Obviously, we try to keep our audience really abreast with what's happening globally, but it's always great to have an expert who is living on the ground and can kind of give us that insight. So I really appreciate you. I think that our audience would be well served to follow more of your work, and I'd be excited to hear about where people can find you.
You can go find me on Twitter. I'm extremely active in there, at Andreas Steno. And then you can find me on Substack. My Substack is called Steno Signals. And then you can find me live on Real Vision in 13 minutes from now. So I host the Real Vision Daily Briefing a couple of times a week. And I also have my podcast, The Macro Trading Floor, out each and every Sunday on right about every podcast app. So I guess that was all.
All right. Awesome. Thank you again, Andreas. Everyone, you got to go follow this man. Folks who aren't paying attention to what's happening in Europe, he presents an enormous amount of alpha. Ansel, where can people find you, sir?
Yeah, check out bitcoinandmarkets.com. You'll find everything I do there. Thanks, Andreas.
All right,
This was very enlightening, and I hope to get you on again.
Absolutely. My pleasure, Ansel, and CK. It was a pleasure.
Yep, absolutely. And hey, to everyone listening, you can find me on Twitter at CK_snarks. Of course, everythingbitcoinmagazine.com. And then lastly, I will be remiss not to mention Bitcoin Amsterdam. Andreas, I hope that you could actually make it to that. If you don't have a ticket, I'd love to give you one after this. But it's going to be an absolute fantastic time, October 12th through the 14th. Andreas is co-host on his podcast, Macro Elf, is going to be speaking there. And it's going to be absolutely fantastic. Over 3,000 Bitcoiners descending onto Amsterdam to talk about what is happening in Bitcoin. Ticket prices are going up this Friday, so make sure not to wait. Get your ticket now. And Amsterdam and the Netherlands completely opened up and dropped COVID travel requirements. So anyone who is on the fence because maybe they had to take an extra train or whatever, that no longer is an obstacle. So come to Bitcoin Amsterdam. We are thrilled to be hosting it in less than a month. And I would also be remiss not to show the print Bitcoin magazine. So you can get a piece of Bitcoin history every single quarter in your mailbox by subscribing to the print issue of Bitcoin magazine. That is over at store.bitcoinmagazine.com. Use promo code BMLive for discounts across all of our products. All right, y'all. Back to you in the studio.